But our next guest isn't worried. Krishna Memani is Director of Fixed Income at OppenheimerFunds. He oversees $70 billion and directly manages $10 billion in bond portfolios. So, Krishna, does it take a brave man to hold European bank debt like you do?
Perhaps not as much as people think. One needs to be brave to hold this paper. The entire thesis here is very simple. That is, the likelihood that European policymakers will let a Lehman moment happen in Europe is very unlikely. At least willingly, they won't let that happen.
So when Jean-Claude Juncker, for example, or Olli Rehn, or even Dieter Zetsche of Daimler, whom we spoke with yesterday, says they will do everything to avert a default, to avert a collapse, to avert a cascading series of defaults, you believe them?
I certainly do, because there is nothing much to be gained by letting the entire banking system collapse when a few €100 billion can at least postpone the problem and give the European banks an opportunity to organically build up their capital.
So on that basis, you feel comfortable investing in European bank debt?
Yes, absolutely. And I think one of the mistakes investors make is putting all European banks in one giant category.
So this isn't really just a sector call. You still have to do some credit analysis.
Oh, absolutely, absolutely, because there are some European banks that have tremendous amount of exposure to peripheral debt, and in an unlikely event can face very serious losses, while other European banks have some exposure, but relative to their capital, the exposure is fairly manageable. So we think those are the sort of banks you should be buying.
So in your mind, which ones do you avoid? Which ones do you like?
Okay, so the avoid part I'll leave alone. The ones that we like are large capitalization European banks like BNP, Barclays, the Swiss banks who have really not meaningful exposure to European peripheral issues, but their spreads have widened just as much as they have widened for other banks who have direct exposure. So we own Barclays, we own Lloyds, we own Credit Suisse, we own UBS, we own BNP, we own ING as a restructuring story. We own other European financial institutions, such as some insurance companies. Again, all of these spreads have widened with the stress in the marketplace, and we don't think it is really, it's not warranted.
I see. So it's on valuation. Strictly on the basis of valuation, these bonds are a good buy.
Yes.
Now, we were talking, you were just explaining that you have to have some confidence in the way European policymakers handle the Greek situation. How much of a factor does Basel III play here? The requirement that banks are going to have to hold back more capital as a cushion against losses and also maintain much more liquidity, the ability to raise cash quickly on their balance sheets?
A lot, in fact, because we think European banks and banks in general on a global basis for bondholders are really good investments, because overall the trend is for them to have a significantly less levered position, their capital levels to be significantly higher, so they may not be the best equity investments, but for bondholders they are fantastic investments.
That raises a very key question. If you're a bondholder, right, you're effectively at the top of the capital structure. You're the senior unsecured creditor.
Indeed.
I know you're not an equity investor, but how much pause would you have buying these stocks?
Well, again, it's more of a valuation story for equity investors, so I'll leave it to the experts in the area. But it would seem to me that even there, the markets are probably overpricing the risks in lots of these names. So, you know, Credit Suisse, for example, is a very good company. It's doing reasonably well. Its capital levels are building up. So good names like that, I'm sure, offer pretty good value. But I'm not an expert by any measure.
The reality is, though, if there are losses and it does begin to wipe out bank capital, it's the equity holders that take the hit.
Absolutely.
How about European sovereign debt? How comfortable would you be buying that?
Well, European, or at least the peripheral European sovereign debt.
Yeah, that's what I'm referring to. Spain, Ireland, Portugal, even Greece. Are there attractive valuations?
The valuations are very attractive, but as a bond investor, you have to be cognizant of the market volatility as well. And we think this is just for a typical core bond type investor who's investing in bonds for some amount of safety, this is just a bit too speculative for our taste.
But if you have a strong stomach, boy, you could really get paid.
Absolutely. In lots of these situations, you are going to get paid, and I don't think you have.
Look at the 2-year yield on Greek government debt, 27%.
Well, and you don't have to buy them outright. There are ways of structuring transactions or ways of structuring your exposure where you can lock in some of these yields and some of these wide spreads without taking all the risk of a meltdown. So you can certainly do that, but I think for that you have to have a portfolio that can take significant amount of risk. Of all the peripherals, we think Ireland probably is the best in terms of if you have a long-term perspective. It's sort of a good company with a bad balance sheet. Its cost structure is significantly better. It's going through turmoil, but I think in the long run that's an economy that I think has a lot to offer. So,
but you're not buying that peripheral debt right now?
No, we are not buying the peripheral.
All right, Krishna, thank you very much for being here. Krishna Memani.